There was a moment, not too long ago, when standing on a balcony overlooking Miami felt like witnessing the future in motion. Glass towers rising, cranes frozen mid-swing against the sunset, and rents quietly climbing in the background, almost unnoticed, until suddenly they weren't quiet anymore. By 2020, something began to shift in Florida that few fully understood at the time. The pandemic had just begun reshaping the American economy, but in Miami, the change wasn't contraction, it was acceleration. While cities like New York City and San Francisco were seeing residents leave in search of space, affordability, and flexibility, Miami became a magnet. Remote work didn't just change how people worked, it changed where they could afford to live. Suddenly, high-income earners from expensive coastal cities realized they could bring their salaries with them. And Miami, with no state income tax, warm weather, and a growing reputation as a financial hub, became an obvious destination. By late 2020 into 2021, migration patterns began to tell a clear story. Wealth was moving south, not slowly, not cautiously, but in waves. Tech entrepreneurs, hedge fund managers, crypto investors, and remote professionals all arrived within a compressed time frame. Demand for housing surged almost overnight. But supply didn't. And that imbalance, that simple equation of too many people chasing too few homes, became the foundation for one of the fastest rent increases in modern U.S. history. Developers had already been building aggressively in Miami before the pandemic, but most of those projects were aimed at luxury buyers and investors, not middle-income renters. As demand exploded, available rental units shrank rapidly. Vacancy rates dropped to historically low levels. Landlords noticed immediately. Between 2021 and 2022, rents in Miami didn't just rise, they surged. In some neighborhoods, increases of 20%, 30%, even 50% weren't uncommon. A one-bedroom apartment that rented for $1,500 suddenly demanded $2,200 or more. For longtime residents, the shock was immediate and brutal. But behind the numbers, there was a deeper force at play, one that had been building for years, quietly shaping Miami into exactly this kind of high-cost environment. Because Miami wasn't just reacting to a sudden spike in demand. It had been preparing for it. To understand why rents in Miami are so high, you have to look beyond the pandemic and into the structural forces that were already reshaping the city long before 2020. One of the most powerful drivers is geography. Miami is a coastal city with limited space to expand. To the east lies the Atlantic Ocean, and to the west, vast wetlands restrict development. Unlike sprawling cities that can grow outward, Miami is forced to grow upward, and vertical development is expensive. Building high-rise apartments requires more capital, more time, and more regulatory approval. That alone keeps supply constrained and prices elevated. But geography is only the beginning. Another critical factor is global demand. Miami isn't just an American city, it's an international one. For decades, it has served as a gateway between the United States and Latin America. Wealthy buyers from countries like Brazil, Venezuela, and Argentina have long invested in Miami real estate as a way to preserve wealth. This means local renters aren't just competing with local residents, they're competing with global capital. And global capital doesn't behave the same way as local demand. It doesn't always care about rental yields or affordability. Sometimes, it simply wants a safe place to park money. Condos sit empty, purchased as investments rather than homes, reducing the effective housing supply even further. At the same time, construction costs have surged dramatically. From 2021 onward, the price of materials, steel, concrete, lumber, rose sharply due to global supply chain disruptions. Labor shortages added another layer of pressure. Developers faced higher costs at every stage of construction. And when it costs more to build, it costs more to rent. New apartment buildings entering the market are priced at a premium simply to justify the investment. Affordable housing becomes increasingly difficult to create, and older, cheaper units become more valuable and more expensive. Then there's policy. Unlike some cities, Miami has relatively limited rent control measures. Landlords have more flexibility to adjust prices based on market demand. In a rapidly rising market, that flexibility translates directly into higher rents. Meanwhile, zoning regulations and approval processes can slow down new development, preventing supply from catching up quickly enough to stabilize prices. But perhaps the most underestimated factor is branding. Over the past decade, Miami has transformed its image from a seasonal tourist destination into a serious economic center. Financial firms relocated, tech conferences expanded, cryptocurrency companies set up offices. Public figures and entrepreneurs openly promoted the city as the next big hub. And perception matters. Because once a city is seen as desirable, demand doesn't just rise, it compounds. More people want to be part of the momentum. More investors want exposure. More businesses want presence. This creates a feedback loop. Demand pushes prices higher. Rising prices signal success. Success attracts more demand. And renters, caught in the middle of that loop, feel the impact most directly. By 2023 and into 2024, the consequences of Miami's rapid transformation became impossible to ignore. For many residents, rent wasn't just high, it was unsustainable. Wages, particularly in service industries that power much of Miami's economy, did not keep pace with housing costs. Workers in hospitality, retail, healthcare, and education found themselves increasingly priced out of the very city they helped sustain. Commuting patterns changed. Some moved farther inland, trading proximity for affordability. Others left the region entirely. But even as some residents departed, new arrivals continued to replace them. This constant churn masked the deeper instability. On the surface, Miami's housing market looked strong: low vacancy rates, high rents, continuous demand. But underneath, there were signs of strain. Developers began launching more projects, attempting to capitalize on high rents. Yet these projects would take years to complete, meaning short-term relief was limited. At the same time, interest rates rose sharply in 2022 and 2023, increasing borrowing costs for both developers and buyers. This slowed new construction pipelines and added financial pressure across the housing market. Insurance costs, particularly in a hurricane-prone region like Florida, also surged. Property owners faced rising premiums, and those costs were often passed directly to renters. Layer by layer, the cost structure of housing in Miami became heavier. And every added cost found its way into rent. Yet despite all of this, demand has remained resilient. Because Miami offers something few cities can replicate: a combination of climate, tax advantages, international appeal, and economic momentum. This makes it uniquely positioned to sustain higher housing costs compared to many other cities. But sustainability doesn't mean stability. Looking ahead, the future of Miami's rental market depends on a delicate balance. If construction accelerates and supply increases meaningfully, rent growth could slow. If economic conditions tighten or migration patterns shift, demand could ease. But if current trends continue, if Miami keeps attracting wealth, investment, and global attention, then high rents may not be a temporary phase. They may be the new baseline. And for those watching from the outside, the question is no longer why rents are high. The question is how high they can go, and who will still be able to afford to stay when they do.